Futures trading involves risk and is not suitable for all investors. Content provided in this segment is meant for educational purposes and is not a solicitation to buy or sell commodities. Opinions and statements of guests not affiliated with EverAg are their own and do not reflect the views of EverAg. The accuracy of their statements cannot be guaranteed by EverAg.
Hello, welcome to another edition of the Grain Feed, brought to you by EverAg. As your weekly news feed for all things grain and all things feed. Each week we bring you updates on the markets with unique perspectives from an amazing team of analysts with the intention of helping dairy and livestock producers manage the risk. I'm your host, Jim Matthews, reporting from Chicago in the Chicago office here at EverAg. Joining me today from Wichita, Kansas, Director of Feed Foundations, Mr. Jake Kingsley, and reporting from St. Louis, Chief Economist at the American Soybean Association, Mr. Scott Gerlt. Scott, how are things?
Oh, things are busy. It's quite the mixed bag these days of positive news and negative news. So we're just trying to find somewhere in the middle.
Yeah, I would say that's right. There's never a dull day in the soybean industry, right? It's it's always going to keep you on your toes.
No, we do not get bored.
Yeah. We've got a lot to run through, but Scott, would you mind just telling or reminding the viewers, because you've been on the show before, what your work is at the American Soybean Association and what the association does for the industry?
So I had the economics department for the American Soybean Association. So we do the market analysis, the policy analysis. So if you see a lot of numbers coming out of the organization, that's probably from my team. ASA in general represents U.S. soybean farmers on policy issues. So almost 500,000 soybean farmers we represent. And we have 26 affiliates in 30 states. We serve farmers. I mean, farmers are our board members, and so everything we do is really determined by them.
Amazing. Well, we appreciate all that you do, all that the association does. So thank you for that. And we are very excited to have you and your insights today. So we will get to that once Paige kindly timestamps the broadcast, because it is Wednesday afternoon. It's about 3:15 Chicago time. The grain and feed markets did close in the red today, so it was a nice clean down day for grain and feed. We did have December corn down 2 cents at 4.24 and a quarter. So corn continuing to trade in this very tight range of 10 plus cents here now, really over the last, it was like 4 to 5 weeks. So it's been a tight one here lately. We've got wheat was down a penny at 5.19 and a half. Novi beans, which we'll be discussing today, was down 3 at 10.09. So still flirting with that $10 per bushel type of trade. We have December meal, that stubborn little byproduct, down 120 at 276.10. And then soil down 4 points at 49.84 today. So everything down grain and feed wise today. And focusing then on the soy complex. Scott, what are we thinking today? Because we did have November beans showing some strength from a futures perspective, at least last week, and then kind of just rolled out of bed really the end of last week pricing wise, and have rolled back down towards $10 on November. But there's a lot impacting the soybean market and how, both futures and the cash markets have been impacted. So what are you seeing as the top impacts as of late?
Yeah, I mean, of course, we're looking at record soybean yields, but areas is low enough this year to prevent a record. But I mean, definitely markets are following weather. But I think really the big driver of this downward price trend has been the export side. We just keep on getting more and more bad news. And by export, I mean lack of exports. So the biggest buyer, China, has not purchased any U.S. soybeans yet for this new crop, which is, already been talked about quite a bit in various spaces. Really, China's trying to do everything they can not to buy U.S. soy, it looks like, just for political leverage. So we saw most recently this week, China going to Argentina and buying Argentinian whole beans in a big way. And they usually do buy some, but just the massive amounts in a short amount of time have really put some downward pressure on markets.
Yeah, that's been a really interesting storyline really over the last few days, right? We're recording on Wednesday. I think we heard from the Argentine authorities, perhaps either over the weekend or beginning of the week, that they would be essentially bringing their export tax on commodities, on grains and oilseeds specifically, down to zero, at least for a holiday, if you will, through either what would be the end of October or a certain amount of agricultural goods in terms of the number of dollars they generate. I believe that number was $7 billion worth. And if that is way off, Paige, do me a favor and throw a number in there that makes sense. But let's say it was. I think we have started to hit roughly 2 billion plus worth of those sales, I think just in a day or two. And like you said, Scott, I mean, this is the Chinese were already doing whatever they could to soak up Brazilian soybeans, stay away from the US or depend on as little as possible. And then suddenly this export tax holiday kicks into gear from Brazil's neighbor, and China says, oh, great. There's more beans from somewhere else. So you noted whole soybeans, right? Specifically because usually the Argentines are a big crushing nation, right? Their export industry often funded from the soy complex side by the byproducts, shipping out meal and oil. So I think that'll be really interesting as well. And Scott, maybe why also the meal market coming under some pressure, because we've got some nice competition suddenly on the protein side too here. So you noted the lack of exports. What's the USDA going to do with this thing as we move maybe into the next couple reports here? Because like you said, we're not seeing any activity here from the big name that we usually look towards.
Yeah, I mean, I think at some point they're gonna have to start growing the stocks category and pull it out of exports. I mean, you can only go so long. We're getting into our export window, right? I mean, harvesters are rolling, soy's coming out of the field. And so you can't move it during this period. You're just gonna run out of time essentially. And it looks like China could be easily booked up through most of November at this point after these Argentinian purchases. So, I mean, even if, the trade war ended today, China really wouldn't even have a lot of market incentive to buy for just a bit. This whole Argentina thing has been fascinating. I mean, there's a lot of history here. As an economist, Argentina is a pretty good case study on how to mismanage an economy. Soybeans are their main export, and that's how they get dollars to pay back their loans. But that's also how they get a lot of their tax revenue is by taxing those exports. And so it's this constant tension. And when they need dollars, they'll lower that export tax or give favorable exchange rates. And that's what they're doing right now. They've eliminated that export tax of, I think, about 26%. And typically they tax whole beans a little bit lower than meal and oil to kind of help subsidize their domestic industry. But I think kind of what rubs some salt in the wounds on U.S. farmers on this one is it was just announced that the U.S. government would be giving $20 billion of assistance to Argentina. That happened right before the export tariff announcement was made by Argentina. So it definitely has the optics of the U.S. help bailing out the president before their election, and then Argentina going and selling soybeans to China instead of the U.S. farmer.
Yeah, it's an interesting look, that's for sure, because I think the U.S. row crop farmer probably could have used a bit more love here. And yes, there's an irony of assisting, the great nation of Argentina, but unfortunately maybe providing yet another source for the Chinese to buy their soybean needs. So yeah, just a really interesting stretch here. And I guess, Jake, to loop you into the discussion and noting how beans have now, have that new alternative in addition to the Brazilians, and then even having that meal element be a part of this. Have we started to see basis react at all to this just yet this week, or is it a bit too soon to kind of gauge where we're going with this?
We haven't seen any immediate response in the marketplace, but I think that's because both basis and futures in feed proteins have been under pressure for quite some time. I guess you could argue that we're revisiting the lows on the futures front, and that's probably the response to this thing. Basis doesn't have to do a whole lot of work when you're doing that on the futures side. I think, Scott, a lot of folks are kind of curious. You've talked about the export side of our demand market here. We've had quite a few questions still on the crush front, and there's some ambiguity there as well regarding 45Z tax credits and the blending requirements that we're going to see in the next couple of years. If we're losing export demand on the bean side, in theory, we've added crush capacity and have cheaper beans here in the US, but we keep bottoming out closer to 280 futures. And we've kind of stalled out at, again, very attractive basis values. But do you see the crush industry changing, catching another surge in growth, or are we kind of stalled out? And what do you see going forward there?
Yeah, I expect it to really pick back up. Crush margins have been strong. Crush numbers are at record levels, although the utilization rates that would be implied by our crushings are a little bit low. But I do expect that to pick up. And, maybe I should back up just a bit and kind of walk through a little more what's been happening industry wide behind that. Last time I was on, we were talking a lot about renewable diesel boom, the growth in crush plants. So it was a really exciting story, but like most of those things, that the story kind of gets a little complicated and takes some twists and turns. And that's what we had seen happening. We produced so much renewable diesel in 2024 that we really exceeded what needed to be blended under government obligations in the RFS. We also transitioned at the beginning of this year from the blender's tax credit to the 45Z producer tax credit you mentioned. There's a delay in guidance. There's a lot of uncertainty about how to claim that. So what happened at the beginning of 2024 is that the biomass-based diesel industry just kind of crashed. I mean, production went really low. At the same time, we've been importing a lot of things like used cooking oil and tallow that compete with soybean oil in the biofuels market. We also saw soybean oil use in biofuels just crash. So we went from having this major growth trajectory to crashing, having a lot of biodiesel facilities sitting idle. And so that kind of set the stage to where we are today. There's been several improvements. One on the 45Z in the One Big Beautiful Bill Act, the reconciliation that was passed. There were several improvements that were made to 45Z. One is indirect land use change penalties would be removed. And this is a bit policy wonk, but credit amount is determined by the carbon intensity. And a lot of that carbon intensity was coming from what's called ILUC. So by removing that from the score, soy is now getting about the same credit amount per gallon as tallow or used cooking oil, whereas before we were about half. So we went from about 30 cents a gallon to 60. The other is that imported feedstocks were no longer eligible for the credit unless they're from North America. And so you had a lot of the Chinese used cooking oil, Brazilian tallow essentially get pushed out for this credit. So that made the credit a lot better. We still haven't gotten final guidance from Treasury yet on it. We're still kind of waiting some of those details before we can fully utilize it. The other thing that's really changed are the proposed blending levels. So EPA has to propose those every year. Current ones run out at the end of this year. EPA was supposed to have the 2026 numbers out by November of 2024 by law. They still haven't finalized those. All we have is a proposal, but the proposal is very, very good. It would increase the minimum blending levels for biomass-based diesel by over 60% from 2025 to 2026. It would also cut the credit amounts for imported biofuels or biofuels produced from imported feedstocks by about half. So those together are tremendous changes. I mean, typically EPA has been very conservative in setting those, and they seem to be taking a little bit different approach here. Instead of saying kind of almost what's the minimum we can do is what's the maximum we can do, which is a very pro-growth strategy. There's some other things on small refinery exemptions that we can get into the weeds on, but basically the biomass-based diesel industry has started to tick back up. We're seeing more production again. 45Z, we don't have final guidance, it is law, but blending obligations, we don't have those final rules. We're hoping by the end of the year. We're hoping by end of October. We're kind of waiting to see if that timeline will be met. But I think we're going to be in a very different story on the biofuel front, which could help take up some of that lost export market. But it can only take up so much, right? I mean, if you don't have the crush capacity, it doesn't matter how many beans you have beyond what you can crush. We still have to export soybean meal too. So that's not necessarily the same countries. That's not really going to China, but you still do have to have exports to someone.
Yeah, and I guess Jake, in terms of the what you have seen on the byproduct side, right? And you've talked a lot about this in terms of the price correction on bean oil, Jake, right? And the policies that Scott has been discussing of seeing that demand, right, to meet some of these quotas and mandates and see bean oil run up. And now, Jake, you've seen this come back below 50 cents a pound here. I mean, it's been a big move lower, closed a key gap on the futures chart that was left open on one of these surges higher. And yet we've also seen meal move lower. And right, Jake, I think there's been a few times where we've assumed, hey, if bean oil is going to pull back that much as a portion of oil share, then perhaps soybean meal would also firm up alongside of it. So, I mean, Jake, any thoughts on what meal then does in terms of reacting to this over, let's say, the next few months? Once crush is done, these beans are at plants, right? And then it's time to move this around to either domestic or foreign end users. What are your thoughts?
If we can finalize some of the blending mandate and tax credit information that Scott's been talking about, you probably get another chance to break through this threshold we've been looking at, because you'll have a lot of beans to crush. You'll have good incentive to do it we got a lot of feed out there, generally speaking, with price pressure on a good chunk of it. So we've been pretty active buying at the 280 type of futures level, right? And basis has been attractive for a while. And it felt like for a long time leading up to this that we could push below 280 and maybe see a new normal type of low. And we just really haven't created that yet. And I think it's because there's still some uncertainty in the marketplace. Folks don't want to get too out in front of themselves here. I think there are still some questions around yield and potential overall production that if we can confirm that we've got as big of a crop as we think we do, that'll help push this thing lower. Until we confirm that, folks are taking advantage of these prices. At the end of the day, these are levels where you can buy inexpensive feed and put some weight on some livestock to turn that into some sort of real cash flow. So still a good opportunity to own feed here. I think if we can get things knocked out by the end of October as hoped for, that might be our opportunity to see the back half of the feed year break into some new territory on protein price.
I guess, Scott, is there anything else you want to touch on before we wrap up here? Any points you want to add beyond that?
There's obviously a lot going on, and policy always matters for markets, but I think this year you can magnify that, right? I mean, the markets are really being driven by sudden announcements, and I think that's going to continue. And so I don't know that we necessarily have a lot of certainty. Things are kind of they're a little spontaneous at the moment. One thing for producers is to always manage the risk. Don't leave yourself completely unprotected out there. There's a lot of issues. There's so much we could talk about just diving into the weeds on all of this. It's really just a very volatile time in the markets, and probably will continue to be for just a bit here.
Yeah, I think it certainly is. And that's why it is very important to have folks like you join us, Scott, because we value your insights, and it does help folks make those decisions in terms of how they are going to manage that risk. So, Scott, thank you very much for being with us today. We really appreciate it.
Yeah, happy to.
Excellent. Very good. And Jake, we'd like to thank you as well. You made a couple of really nice points yourself.
Thank you.
You're very welcome. We'd also like to thank the EverAg Insights crew for their support. Big thanks to Paige for production magic, and thank you to the viewers for watching the grain feed. Contact information is on the screen. We greatly appreciate your feedback. That's all for today. We'll see you next time on the Grain Feed.